Hello folks, today we're going to be talking about closing entries, otherwise known as step 8 of the accounting cycle, closing entries. Before we get into that, however, we got to talk about something that's important in allowing you to do your closing entries and also to prepare financial statements. Now, as we stated in the last video, um, you prepare your financial statements. After you do your adjusted entries, you post and or you journalize and post your adjusted entries. Then you can go ahead and prepare your adjusted trial balance, and then after that, you can prepare your financial statements. Your financial statements are made public and go out there to the world for every interested party to see. Okay, now closing entries, step 8 of the accounting cycle. That is house maintenance for you. Okay, you're going to close what are known as temporary accounts. Temporary versus permanent accounts. Permanent accounts are going to be all the accounts on your balance sheet. Those stay. Your temporary accounts are going to be your income statement accounts. Okay, your income statement accounts. Okay, retained earnings, that's a permanent account as well. It goes on the balance sheet. Now, a helpful tool that can aid you in preparing your financial statements, in doing your adjusted entries, and also not necessarily closing entries, but the adjusted entries and preparing the financial statements is what is known as a worksheet. Now, a worksheet, as it says on this beautiful PowerPoint here, um, is a multi-column form used in preparing financial statements. Not a permanent accounting record. It's not a financial statement. It's just a worksheet. It helps you in preparing the financial statements and preparing your adjusted entries. Of course, you should use a computer for this. Make your life easier. You can link cells in Excel and all that. If you're familiar with Excel, it'll just make your life a whole lot easier. Okay, but a worksheet is a helpful tool. Is it necessary? No. But if you are a no voice, as they say, a newbie, then this is a helpful tool to help you out. Okay, or even if you're an expert. Okay, because sometimes you don't even need to journalize these adjusted entries. You can just do them on the fly, and that'll be that. Okay. Um, Again, it's not required. Okay, it's not part of the accounting cycle or anything. It's just a helpful tool that will aid you in preparing financial statements and preparing your adjusted entries. So, what does the worksheet look like? This is what it looks like. Okay. Um, Again, you have all the account titles on the left, as like you would with a trial balance, and then you have a trial balance column or columns. Okay, and notice that they are classified as debits or credits. Okay, so here on the left side you will have cash, and it'll be stated in terms of the balance sheet account. So assets will be listed first, liabilities second, and then your stockholders' equity section, which will consist of the extended stockholders' equity accounts like revenues, expenses, and so forth. Then at the bottom, you will have a section for your adjusted entries. Okay, but you start out with the trial balance, whatever you did throughout the um, normal period. Okay, you will get these numbers from the ledger. You'll get all the account titles from your chart of accounts or the ledger, whatever accounts you use throughout the period. Okay, so if it's cash, you will just put that in the debit side for whatever amount it is. Accounts receivable, you will put that in the debit side for whatever amount it is. Okay, so we have a trial balance heading and then two columns, debit and credit. Okay, then we have adjustments, an adjustments heading, and then we have a debit and credit column for adjustments. Okay. Then we have an adjusted trial balance, just like you've seen in other videos, and we also have a debit and credit classification for the adjusted trial balance. And then you have your income statement and balance sheet, again, headings, and then you have a debit and credit column for the income statement and a debit and credit column for the balance sheet. And as you can see here, step 1, prepare the trial balance. You start with that. Then you do your adjusted entries, okay? Then you prepare an adjusted trial balance, and then you can go ahead and transfer these amounts over to the income statement and the balance sheet columns, okay, where they belong in terms of debits and credits. And we'll work through this and see how to complete this process, okay? So here we have an example, okay? We started out with the trial balance, and if you were following other videos, these numbers are coming from that one example that's used throughout this PowerPoint for this book, okay? So we have cash, supplies. Again, assets are listed first. Then we have your liabilities, and then we have your retained earnings. Okay, your stockholders' equity section. Okay, your stockholders' equity section, and then they just do a trial balance here, and the numbers equal each other. We check the journal, we check the ledger, verify that all information is correct, and we prepare the trial balance. Notice it's listed in terms of debits and credits. All your assets are going to be on the debit side unless it's a contra account. Okay. Dividends are going to be on the debit side. Remember, dividends follow the same rules as expenses. They increase on the debit side, decrease on the credit side. And then you have your liabilities, which are going to be on the credit side, and your stockholders' equity are going to be on the credit side for the most part. Okay, expenses work like dividends again, so they belong on the debit side. So that's where we get these balances from the ledger. Okay, if it ain't broke, don't fix it. On the ledger, these balances are going to be reflective. Okay, so if on the ledger it says that we have a debit balance for cash of $15,200, just transfer it as is, okay? If it's not broke, don't fix it, okay? Just transfer it as is from the ledger, okay? So that's the trial balance on the worksheet prepared here, okay? Here we have some transactions that happen throughout the period, and again, these are not throughout the period, but these are the adjusted entries. So once you journalize the adjusted entries, okay, then you can transfer them and post them to the ledger. Then you can transfer them right into the worksheet, or you can just use the worksheet and then do your journal entries later. If you are an advanced accountant, that's great for you. But if you're you're a newbie, or you are new to accounting, then go ahead and do your journal entries, post them to the ledger, and then you can also use the worksheet just to help you out in preparing the financial statements. Again, the worksheet is not required, okay? Nobody is putting a gun to your head telling you to use a worksheet, okay? But it's just helpful to get you an understanding how this accounting world works, okay? You gotta smell it, okay? You gotta take it in, okay? So, once you do your adjusted entries, you can post them directly on the worksheet. Now, a lot of people get confused on this step. This is the second step, the adjustments, okay? So, as you notice here, you will never see cash in an adjusted entry, okay? Cash will never be in adjusted entry. Let me repeat that one more time. Cash will never be in adjusted entries, okay? So here we have supplies expense, supplies. This is the adjusted entry just to correct the supplies balance to what it should be, okay? So if we go back to the trial balance for supplies, we started out with $2,500. That's the supplies that we bought, right? Supplies that we bought. And then we just left it there. People used the supplies throughout the period, and then at the end of the period, we went to the supply closet and we took a count, and it seems that we only have 1,000 left in supplies. Okay, so we have to account for what we used, and in this case, it appears that we used 1,500 worth of supplies throughout the period. So we increased supplies expense account by 1,500 debit, And we decreased the supplies account by 1,500 and asset by 1,500. Okay, the reference numbers. These are just the numbers that we assign to that account. Okay, so supplies in this case is 126. Supplies expense is 631. Okay, as it happens to be. Okay, and we went over this when we covered the chart of accounts. You can take a look at that in a prior video. Okay, then we have some other adjusted entries. Looks like we used some insurance, so we increased insurance expense. Decrease prepaid insurance to show what we use for the months. Okay, the months, $50, $50 in this case. Then we have depreciation expense, accumulative depreciation. We covered this in a prior video. Looks like equipment depreciated by $40. Okay, and that's per month. Okay, multiply 40 by 12 and you get the year's depreciation. Okay, you can work with that all you want. Okay, then it looks like we earned some revenue. First we had it booked as unearned revenue, 1,200. Then we earned 400 of that. Okay, so it looks like this is revenue for 3 months, but they paid us uh, in advance, and we didn't provide the service yet until it came to the end of October when we did. So we have to transfer it from a liability account, debit in unearned service revenue, and then credit in service revenue, which is what we earned. Okay, so now we can recognize it as revenue. Remember, you don't recognize revenues until the performance obligation is completed. In this case, 1 month of the performance obligation was completed. Then we have people who are paying on account. So we increase accounts receivable to open up an account for these individuals. So we probably sent them an invoice. And then we increase revenue. In this case, you can't recognize revenue because you provided the performance obligation or the service, the sale of merchandise or whatever, but these individuals have not paid you yet. Don't be confused with unearned service revenue. Okay, in this case, we did earn it. Okay, we did earn it. This accounts receivable, credit, service revenue, that would be an accrual. Unearned service revenue, that would be the deferral side. Okay, if you remember when we were talking about accruals and deferrals. Okay, then it looks like we incurred some interest, probably notes payable. Okay, so we have to accrue interest expense, so increase that $50, and then interest payable to show that we have to pay this interest at some point. Okay, in the future, and it says it right here. It's a record interest on notes payable. Okay. Then we have some employees that we have to pay in the future. Not quite yet, but in the future. So we just remind ourselves that salaries and wages expense is going to be increased by 1,200, and salaries and wages payable is a liability to show that we have to pay these individuals in the future. Salaries and wages expense goes away. Don't worry about it anymore. And then when we actually go to pay these individuals, we will debit salaries and wages payable, and then we will credit cash. Okay, not an adjusted entry, just when the pay period occurs. Okay, so those are all the adjusted entries. Now on the worksheet, this is how you do it. Any accounts that don't show up originally throughout the period, so from cash all the way to rent expense, you will, after the totals line, you will look at your adjusted entries, and any new accounts that appear here that weren't here before throughout the normal period, you will place them here. So for example, supplies expense will show up after totals, insurance expense will show up after totals, cumulative depreciation expense, accounts receivable, because it wasn't up there, and then interest expense, interest payable, salaries and wages payable. Okay, now if the account is up here, then you would just go to your adjusted entries. For example, let's use supplies. Okay, supplies was on the original trial balance. Okay, as you see here, 2,500. Now, when we go to the adjusted entries, we see that we credited supplies for 1,500. So when we go to the worksheet, we are going to go to this adjustments heading and then go to the credit side under supplies and put 1,500 there. Okay. The other side of this journal entry is supplies expense. Supplies expense was not on the original trial balance, so we put it under totals, and then it was debited in the adjusted entries, so we also debited here on the worksheet. 1500, everything balances great, okay? And then you go to your adjusted entries and do the same thing for insurance expense and prepaid insurance, okay? Insurance expense was not up here in the original trial balance, so you put it down here and you debit it just like it was in that adjusted entries journal for $50. And then you credit prepaid insurance just like it was credited on that Justin Entries journal for $50. Okay, $50. Okay, and you go through that and you basically complete what you did here just on the worksheet. Okay, makes your life easier. And then of course you have to sum up the debits and credits, make sure they're equal, which is basically what you have in the journal here. You just add in these numbers on the debit side and add in these numbers on the credit side, and you can already tell that they're going to equal because 50 for 50, 40 for 40, 400 for 400. Okay, so you're already gonna know that they're gonna equal out. Okay, so everything looks good. We can move on to the adjusted trial balance. Okay, now as I said, people get confused with these two headings here, adjustments and the adjusted trial balance. Cash, you're going to transfer over from the original trial balance to the adjusted trial balance as is. Remember, cash will never be in an adjusted entry, so you know that number is going to just transfer over as is. Okay, now supplies. You got to think about the normal balances of these accounts. All your assets, with the exception of contra assets, are going to have a normal debit balance, right? In this case, for supplies, it's 2,500. That was the original. That's what we bought it for. But then you see how this is a debit balance on a trial balance. You got to go do the heading and then look at these two columns and see what is the normal balance. In this case, it's 2,500. Then you move over to the heading first, adjustments, and then in here we have a credit to supplies of 1,500. So if it's a debit and a credit, you got to subtract. Okay? If it's a debit and a debit, depending on the account, then you add. Okay? So for assets, if it's a debit and a debit, you know that their normal balances are going to be debits. So debits are good for assets, so you add them together. Okay? So if this 1,500 was a debit, then you take 2,500 plus 1,500. But in this case, it's not. Okay? It's a credit. Okay, so it goes the opposite way. So just in your mind, you got to think. Supplies, an asset, has a positive normal balance of 2,500, but then we credited it for 1,500, so we got to subtract that. And when we do, we can move over to the adjusted trial balance and just take 2,500 minus 1,500, and that gives us 1,000 remaining on the debit side. 1,000 remaining on the debit side. Prepaid insurance, same deal as I just explained. You have a credit, normal debit balance, sorry, of 600, and then you used up 50, shown here as a credit. So you take 600 minus 50, and then you are left over with 550 that you have not used up, and that goes over to the debit side. So you got to think about the normal balances of these accounts. Prepaid insurance, for example, 600 positive debit balance. We credit it 50, and then whichever side is bigger is what you transfer over to that adjusted trial balance, okay, as what's left over. Equipment was not touched, okay, in that adjusted entry, so you just transfer that over as is, okay. Notes payable was not touched, so you transfer it over as is. It was a credit, okay, no adjustments, and then you transfer it over as a credit on that adjusted trial balance. And then for accounts payable, same deal. Unearned revenue was touching the adjusted entries, has a normal credit balance because it is a liability, and in this case it's 1,200. Then we debited it. That's what we earned when we did the adjustments. Okay, so here we have a credit, and then in the adjustments we have $400 debit, so we got to subtract here, and then the remainder goes over to the credit side under that adjusted trial balance. The remainder is 800 in this case. Common stock was not touched. Dividends was not touched. Service revenue we did touch. That is the other side of this $400. Remember, we earned that revenue. So here you have a credit and a credit, so you add. Remember, service revenue has a normal credit balance, so credit is going to increase it. And in this case, we add these two together, and we get credit of 10,600. Okay, because we had two of these adjusted entries for service revenue, if you remember. And we go back here, we had the 400 for service revenue that we earned, and then the 200 for the people who are going to pay us on account. Okay, that's why you see the two here, 400 and the 200. Okay, and then we get addition. Okay, 10,000 plus 600, which is 10,600. Okay, salaries and wages expense was touched. Okay, in the adjusted entries, 4,000 here, and then we debited it for 1,200. Add these two together, and then we get 5,200. Rent expense was not touched, so you just transfer it over. Debit, debit. Okay, and you keep going. After totals, all these are going to be new accounts. Okay, new accounts. So you just go from the adjustments column. There is no trial balance, an original amount for all these accounts after totals. Okay, so you just transfer them from the adjustments. Okay, 1,500 debit, 1,500 debit for supplies expense, $50 for insurance expense, debit. Then you transfer it over as a debit, and he goes through the rest of these. Be sure to be careful when you are transferring these amounts. Okay, $40 credit for accumulated depreciation. $40 is transferred over to that adjusted trial balance, and you do the same for the rest of the accounts. Once again, you sum up the totals, and these two numbers should match. If they did not, then you got to go back through and find out what you did wrong. Maybe you transferred a figure that was supposed to be on the debit side, and you put it under the credit side, and maybe that's why. Okay. Then after that, once you get to this step, the adjusted trial balance, then you can move on to the income statement and balance sheet. This is the easy part. All you have to do is just work from the adjusted trial balance, okay, and transfer these amounts to where they belong. Cash goes on the balance sheet, supplies on the balance sheet, equipment on the balance sheet, notes payable on the balance sheet. Okay, equipment on the balance sheet as a debit, then notes payable on the balance sheet as a credit, accounts payable on the balance sheet as a credit on the credit side, unearned revenue, same deal, common stock, same deal, dividends. It's going to go on the debit side. Remember your accounting equation. Remember the normal balances of these accounts. Okay. Then he goes through. What else belongs on the balance sheet? Revenue does not belong on the balance sheet, so you're going to put that on the income statement. And you're working from the adjusted trial balance, okay? Forget about the trial balance and the adjustments, okay? You're working from the trial balance when it comes to the financial statements, okay? Salaries and wages expense belongs on the income statement on the debit side. Remember, expenses get subtracted from your revenue. Rent expense, debit side on the income statement. Supplies expense, anything that says expense is going to be on the debit side of the income statement. Okay, cumulative depreciation is going to go on the balance sheet. On the credit side, remember it's a contra asset. Technically, it's an asset, but it is a contra asset. Cumulative depreciation is like, the cool kid in school, and all the rest of the assets are the losers. So whatever the geeks and the other assets do, cumulative depreciation goes the opposite way. Okay, so cumulative depreciation is out here smoking, drinking, and all this stuff, while the squares, the assets, are going to be on the debit side doing what geeks do. I'm not sure. Okay, then we have depreciation expense. Again, all expenses go on the income statement on the debit side. Interest expense, same deal. Okay. Um, Accounts receivable goes on the balance sheet on the debit side. Um, then we have interest payable goes on the balance sheet on the credit side because it's a liability. Salaries and wages payable, same deal. Okay. Notice for the income statement, these two totals do not equal each other, and you will see why. Because we have to account for net income. And also on the balance sheet, these two numbers do not equal because we have to account, yes, you guessed it, income. Okay, net income. Okay, so you'll see here, once we take the 7,740, which are all our expenses, and we subtract that out from our revenue, we get this net income figure of 2,860. And now the two balance. Okay, your revenues equal your expenses plus net income. Okay, 10,600, 10,600. Now, for the balance sheet, people also get confused here. These two numbers do not equal each other because we have to add net income to the credit side. Remember, net income gets added to retained earnings. Here, we don't have a beginning retained earnings, but if we keep this income, this will be our new retained earnings figure. And that goes on the balance sheet on the credit side. And now, as you see, these two numbers equal your assets, equal your liabilities plus stockholders' equity on the balance sheet. Okay? That's how that works. And that's pretty much it for the worksheet. You're done, and now you can go on and prepare your financial statements. Okay? Your revenue or your income statement is just going to go directly from the worksheet. Okay? Your revenues are going to be listed first. Then you subtract out all your expenses, and all the numbers are given for you. So all you have to do is just plug them in. Okay? And as you can see, the net income figure is still there. It equals what's on the worksheet. If it's not broke, don't fix it. And here is what I was talking about as far as net income. We did not have retained earnings beginning. Okay? So we add our net income, we paid some dividends, and we have a new retained earnings figure for the current months, the current period, the artificial time period. Okay? The artificial time period. Okay. And then we go on to the most important statement, the balance sheet. The balance sheet, you have all your assets listed. As you can see, your cumulative depreciation is going to be subtracted from whatever account it belongs to. In this case, it's equipment. And we get this figure, and then we add the two together, or add all our assets, and we get a figure. And then liabilities and stockholders' equity. We add all these numbers up, and we get a figure, and the two match, and that's it. That's it. You can take a look at the statements, the financial statements of any of your favorite companies, Amazon, Walmart, whatever the case may be. Okay, whatever the case may be, and just dive in, dive in. Now, notice for the worksheet and these financial statements, some of the numbers don't match each other. Because on the worksheet, you are working in terms of debits and credits, okay? You're classifying each of these accounts in the debit or credit column. When you go to and you're not doing when it comes to the income statement and the balance sheet, you're just adding all the debit side and all the credit side. And then you have net income that plays a factor, okay, but you're not subtracting out dividends. You leave the subtractions when it comes to the statements themselves. Okay, so here you can see that expenses are subtracted from revenues, and we get this figure, and we get net income that matches the worksheet. Okay, here for the retained earnings statement, we did not subtract dividends on the worksheet. We added dividends because we're going based on debits and credits. But here on the financial statements, we do subtract them. Okay, we do subtract dividends, and then you have this retained earnings figure, which you see on the balance sheet here, okay? Which you see on the balance sheet. And we also subtracted cumulative depreciation from assets. So when it comes to the financial statements, that's when you actually do the subtractions, okay? Not to be confused with adjustments on the worksheet, okay? You do subtractions there. And additions sometimes, okay? But you mostly leave that for the financial statements, okay? So that's all I have for you today. On the next episode, I know I said step 8, but this is going to be a 2-part video. Yes, I changed my mind. And we're going to talk about closing entries. Closing entries are really simple, but this was an important step that you must observe, or just if you're a newbie, if you're advanced even, so it can make your life easier in preparing the financial statements and doing that adjusting entries. So I'll see you in the next video. Goodbye.